Lori, market. So look, we could go through March, and many of us did, and you did, and said it's not going to be this easy forever. We had no 2% pullbacks, so we were kind of due for some kind of a setback. But what specifically do you think the market's contending with? Obviously, we got the geopolitical headlines, the higher for longer story, and then, maybe just a question about whether this economy can handle what yields are giving it.
Yeah, I think it's a really strange time in the market right now. We've been overdue for this pullback. Sentiment has been stretched. I mean, I've been worried since January. We're finally getting the pullback now. I think you've got a combination of de-risking to some extent. I think you've also got the begrudging acceptance of a hot economy continuing to build, and that's what I'm really seeing in the rotation today. We're seeing secular growth themes getting sold pretty hard. You don't need secular growth as much when cyclical growth is picking up. And, I think I saw today the consensus GDP forecast is up to 2.4%. That's pretty darn close to average.
For the full year?
For the full year.
Yeah.
And in a hot economy, you typically see value and small cap and cyclicals outperform. It's the cool economy that growth and secular growth themes tend to dominate. We're on the cusp of exiting that.
We do have things like banks up today, energy up today. So part of that cyclical value trade, perhaps. I guess the question is, if earnings are going to hang in there in general, do we need any further setback than we've had already?
So to me, a garden variety pullback is 5 to 10%. That drawdown that we had last fall when interest rates were spiking was about 10% on the nose. So there could be a little bit more to go. We've got to watch the sentiment indicators pretty closely, and they've been pretty frothy. So I think it's going to take a little bit of work to really get them down. I don't think you have to turn to an uber bear here as long as we've got the economic tailwinds at our back. The reality is if you see a pullback more than 10% in kind of the 15 to 20% range, that's typically associated with a growth scare. And I don't think we're talking about that right now. So even if it gets a little bit worse, I wouldn't really expect it to go too far below, say, 4,700 or so.
Victoria, your take on, whether, in fact, the market is telling you either to be more defensive or if it says, look, let's get used to an economy that's just running at a higher metabolism.
Yeah, I think there's a little bit of both built in there. As Lori mentioned, pulling back to kind of that 4,800 level gives us that 10% correction. That's that 200-day moving average for the S&P. So it makes sense that would kind of be the place to go in and start adding. But you look at some of the things we're seeing, you've only got less than 30% of the S&P trading above its 50-day moving average, right? Put-call ratio moving higher. You look at the flows, the volumes of flows into short S&P ETFs, that's increasing. So I feel there is very much a defensive mood around the markets, and so put some defensive into your portfolio. Some of those areas are doing better. Utilities, which typically don't do well in a rising rate environment, but we're seeing it now. Names like telecom, low beta, good cash flow companies, I think, is where you need to park some money right now, because we do think, as we've been talking all year, we do think we're going to see probably another 4 to 5% pullback here.
Those things that you do mention, though, money flowing into short funds and people hedging more and essentially showing some concern, are also the makings of a bounce, right? I mean, that's what you have to watch for.
They are, and you typically have kind of three different elements, right? When you have a complete turnaround here, you have the initial pullback, then you have a bounce, and then the third leg of that stool is you go back lower. So maybe we're getting a little bit of a bounce here. I think you watch discretionary versus staples, watch that ratio, see how that's going to do. It's consolidating right now. If we see that start to pick up, then maybe that tells you you're in that second phase of the bounce.
Kevin, as you look at companies and how they're valued right now and their prospects, do you feel like you're getting more opportunities? Do you feel like the companies are telling you that the outlook is getting better? Or how are you navigating it as, S&P's down 5%, the majority of stocks down a lot more?
Right. I think it depends a lot company by company, which is how we operate. We're very bottom up. But to some of the questions from earlier, the market's been grappling with this. What are rates going to do, which relates to what's inflation going to do. And what was it, a few months ago, I think consensus was we'd have 7 rate cuts this year. And we're down to, I don't know if it's 2 now or if we're at 0 already. But
2 maybe.
But, I think, I'm not sure we're expecting much in the way of rate cuts this year. So probably a higher for longer kind of environment, which makes things like pricing power really, really important. We tend to gravitate towards those more stable cash flow generating companies, whether they're consumer branded names, a waste collection name. We've got some, names you might call defensive in there, but also a lot of cyclical type names in the industrial area that are benefiting from a lot of the underlying trends that are going on.